Okay, hello everyone. Good to see you again. So let's continue our yesterday's session. We talked about how money creation works in real world, what the central bank's role is in this money creation process. And now we want to expand on this later part, how, like in practice, monetary policy can influence money creation process, and when this influence is not strong enough, what we have to do to improve this transmission mechanism so that we have a better control over money creation process. Unlike this textbook approach, which says that if we central bank simply prints money and that means direct control or like over broad money aggregates. In reality, this control is not direct; it's indirect, and this indirect control can be weak, so that our transmission may not be working very well. So that achieving our objectives can be complicated. So that's what we want to talk about: how we can improve this transmission to money creation process, and therefore to other macroeconomic aggregates like demand and inflation. So let me quickly recap what we discussed yesterday. So we discussed that the two major sources of money creation are credit extension by banks and government's deficit spending. Those two usually lead to deposit creation. That's what we call money creation, because deposits are good medium of exchange. Even though they are a liability of a commercial bank, a promise by a commercial bank, they still function as a good medium of exchange because one, central bank guarantees a one-to-one convertibility, and two, banks are well supervised and regulated, so they are credible and not to default, and therefore their promises are worth so much that they are used as a medium of exchange. But then central bank comes into the picture, meaning that when deposit is created, even though it's a liability of a central bank, some people still don't want to use deposits. They may want to cash out some part of their deposit, and that means then demand for central bank money is created. And cash is something that only central banks create in today's environment by law, and therefore, if there is demand for cash, then central bank has to step in. But in today's monetary operating framework, central banks always satisfy this demand for their money because otherwise interest rates would diverge from the central bank's policy rate, something that central banks don't want to see. And therefore, if there is increased demand for central bank money, central banks passively supply and satisfy this demand, which means that central banks are trying to control interest rates for good reason, because these interest rates are something that define demand for credit, and this is the way through which central banks can affect money creation process. So we can say that even like forget about inflation targeting framework. Even if you have a monetary targeting framework where you want to control broad money aggregate, even in that case, you still need to have some idea on what, where interest rates are going, how your actions are impacting interest rates, because those interest rates are ultimately something that will define money creation and therefore broad money, something that you would want to target. So that means interest rates are key in monetary policy, in whatever kind of framework you operate. Because central banks' instruments have direct control, like a first lag of transmission is central banks' instruments have impact on interest rates, and then interest rates have an impact on credit and money creation, and therefore the rest of the economy. So now that's what I want to talk about, how central banks control interest rates and how they impact credit interest rates. So for that, let me quickly discuss this expectations hypothesis, which tells us how long-term interest rates are defined. So this is one of the leading, kind of one of the standard theories that we teach about how long-term interest rates are kind of established, how investors by demand push in long-term interest rates in a direction that's consistent with their expectations of short-term interest rates. And the idea is that if you think that you have like two options. One is short-term investment investing in some short-term asset, and once it matures, then you just roll over and then you reinvest in the same type of short-term investment, and over again until your kind of investment horizon ends. The other approach, you just use your money and directly invest in the long-term asset with the same duration as your investment horizon. And the idea here is that those two approaches should give you the same return. Otherwise, then you have a kind of an arbitrage opportunity, which every investor would try to exploit. And if they try to exploit this arbitrage opportunity, then they are going to drive some of the interest rates in a direction that will equate returns of these two strategies. For instance, if short-term interest rates are expected to remain very high, then you would prefer to invest in the short-term investment rollover strategy. And all of the investors will do that, so that there will be no demand for long-term investment, which means that the interest rate on this long-term investment will gradually go up. Because if there is no demand on something, then its price should decline. And price of an asset declining essentially is a flip side of its return increasing. So this is an example that I think kind of applies to the Fed policy rate, or at least 1 month interest rate in the US versus a 3-month interest rate in the US. So 3-month interest rate in the US is somewhere close to 5.25%, and the current 1-month interest rate in the US is something like 5.5%. So by simple calculation, it means that over these 3 months, the market is expecting declines in the very short-term interest rates. Otherwise, if there is no expectation of a decline in short-term interest rates, this 3-month interest rate seems too low, which means there would be an arbitrage opportunity for investors. But assuming, because like a U.S. Treasury market and U.S. Financial system is quite deep, we wouldn't think that there will be so obvious arbitrage opportunities, which means that if this pricing is efficient, it means that investors do expect some declines in policy rate in the very short term, in the next couple of months. So this is kind of in a nutshell why we say that it's not just short-term interest rate that the central bank set that we care about, but also about the expectations that we that kind of influence about our policy rate in the future. If even if the short-term interest rate is kind of unchanged, if we affect expectations of the future policy rate, we can still have an impact on the long-term interest rates. Because if we reduce expectation of policy rate in the future, it means that this short-term investment rollover strategy becomes kind of a less profitable for an investor, and many of them will switch to longer-term investment, and therefore they will drive down these interest rates, so that then this arbitrage opportunity is exploited. Which means that long-term interest rates reflect expectations of future short-term interest rates, and that's like a basic idea why we care about the influencing expectations of our policy rate in the future. So that's one thing. But the other thing is that I want to emphasize is the risk in these strategies. So if you kind of invest in long-term strategy, you are fixing your interest rate. If you will invest in short-term kind of a rollover strategy, your interest rate will change depending on economic conditions. Which means that while on average or in expectation, these two strategies can be equivalent in terms of a second order, in terms of like a risk, these two strategies may not be equivalent, because one has a risk, one has interest rate risk, the other doesn't. For instance, this long-term interest rate, if you invest in long-term interest rates and you fix your interest rate at 5.25%, and 1 month passes, and then you realize that short-term interest rates, instead of declining, they increased. Which means now you are having a capital loss because you invested at a lower interest rate, and in fact, interest rates in the future started to increase. Which means that ex post, you realize that if you had invested in short-term rollover strategy, you would have gained. because interest rates started to increase. So next month you would have like maybe 6% return on this short-term strategy. So because there is uncertainty about short-term interest rates in the future, this long-term interest rate becomes risky because you may have capital loss. You may have capital gain as well if interest rates decline faster in the future. If short-term rates decline faster, then, for instance, if here instead of 5.25 interest rates decline to, I don't know, 5% or 4%, it means that this investment will be more profitable than you expected before, which means you will have capital gains. But because we assume that investors are usually risk averse, so that they are afraid of losses more than they are kind of excited by unexpected profits, they would require some compensation for taking on such a risk. Maybe 3 month horizon is not big enough to think that they will require like meaningful amount of risk premium. But when you talk about like over years, 10 years, then the risk is significant. And then you would think that there should be some risk premium that's required by investors, which means that this 5.25 long-term interest rates may be somewhat higher than a simple average of these short-term interest rates. In this example, they are like exactly equal. So like 5.25 is exactly equal to average of those three numbers. Yes.
Just a question. So the risk premium from holding a long-term asset, is it mostly driven by this, like by this fear of possible capital losses of holding long-term investment, or is it also might be driven by like potential defaults or anything like that? What do you think is mostly driving this component?
So default, we call default risk kind of a different type of risk premium. So this is interest rate risk premium, which is sometimes called term premium. So we are now talking about term premium, which is solely about this interest rate risk. But we may well have this default risk, which is a kind of credit risk, and that will be on top of this. And we will actually see this on the next slide, that we also take into account that. So this term premium is reflecting interest rate risk, and that's something that will also define long-term interest rates. Well, this term premium can also be affected by central bank large-scale asset purchases. Take QE examples. When central banks were buying long-term assets, they were essentially buying these long-term assets on their own balance sheet, which means that investors had less long-term assets on their own balance sheet, and therefore investors would be less kind of concerned with interest rate risk, because they are now having less exposure to interest rate risk. If investors or like a private sector has less exposure to interest rate risk, they may be inclined to reduce their compensation. They may ask for lower compensation for taking on interest rate risk. And that's essentially the idea of QE. What QE tries to achieve is central banks take away this interest rate exposure from the private sector. Private sector has less exposure on interest rate risk, and therefore they reduce interest rate risk premium. Essentially, term premium declines. And that's like one key channel through which QE works. Even if QE has no impact on short-term interest rates, it can have an impact on term premium. Well, some people think that they may actually have some impact on expectations of future interest rates as well. Like one example can be if central bank buys long-term assets, now interest rate risk is on the central bank balance sheet. If for some reason central bank is forced to increase interest rates in the future, it's the central bank that will incur capital losses. And by the way, that's what many central banks have experienced recently. Which means that if central banks will have capital losses, some may think that central banks will be somewhat reluctant to increase interest rates to incur less capital losses, and that means that QE can have some effect on interest rate expectations. But as long as central bank is not worried about capital losses, because it's not like a usual private entity which would default with negative equity, central banks can operate with negative equity. So that's a different issue, but still something that expectations of the future interest rate may not be that much affected if people think that central bank will be resolute or clear with its objectives and still increase interest rates no matter what the losses will be on its own balance sheet. But anyway, so the point is term premium is the key channel through which QE works, and we have to keep this in mind that there is interest rate risk that can complicate this transmission from short-term rates to money creation process. Yes.
So the term premium depends on the maturity, right?
Yes.
And also, if we expect short terms to increase over time, does that also assume that long-term interest rates have term premium, or in that case we do not have?
Well, so that's a
Sorry,
good point. So
if we expect it to decline, not the short terms.
So if we want to complicate things, so we can say that term premium is kind of a state contingent. It depends on the level of short-term interest rates. But in like up to first order approximation, whatever short-term interest rate is, if there is a chance that it can go up as much as it can go down, then investors will still require the same amount of term premium, no matter where the short-term interest rate is expected to go. If there is an expectation that interest rates will go down gradually, there can be expectations that interest rates can go down much faster, or if, expectations that they won't go down at all. So if the kind of the risk is symmetric, then we can say that the term premium is similar. But if you're kind of hinting towards direction that if interest rates have gone up to such level that it's like almost impossible for a central bank to increase it further, then investors may be less worried about risk that interest rates can go higher than lower, or we can have like a opposite example, which may be more kind of clear. If interest rates have already gone down to the effective lower bound, then interest rates can't go down any further. They are at the effective lower bound, which means that at this point, investors will not be worried about interest rates going further down, because that's not possible. And therefore they will be concentrating on the upper side of interest rate. So this means that depending on where we are, depending on the state of the world, interest rate risk can be perceived differently, so that term premium can be different. But if we are somewhere close to steady state, then going up versus going down is like a similar risk, and therefore term premium can be similar in whatever the expectations of the short-term rate is.
Thanks. What I meant is that if we expect short terms to decline, we prefer to invest in the long term, right? So how is it? We are just fixing the interest rate for a long term. How that means that we have risk, we acquire risk?
This is an example. We expect short-term rates to go down. Everyone would prefer long-term asset. And if everyone invests in long-term assets, these interest rates go down as much as it will make you indifferent between investing short-term versus investing long-term. So take a look at this example. You would be indifferent between these two, like disregarding interest rate risk. This strategy gives you as much as the lower one, because the average of this strategy is equal to this interest rate. It means that you wouldn't prefer long-term investment. You would be indifferent. So that's the point. Long-term interest rates reflect the expectations of policy rate. Even if policy rate is expected to decline, this will be reflected in long-term interest rate, so that they already incorporate these lower policy rate expectations in it.
So about the central bank money, about the credits and possible losses of the central bank's capital.
Yeah.
So how does central bank gets value from? It just creates the reserves. If I'm
Yes.
correct. Yeah. So then why, like, what is the logic of central bank worrying about the capital losses if they can just create reserves for themselves? Like, I don't know in which
Yes.
possible scenario does it
Like there is not much economic reason to worry about it, but there is kind of a political economy reasons. Like if government is pressuring not to recapitalize central bank, and if central bank worries about this possibility in the future, that can be an issue. But as long as central bank is kind of independent and this is respected, then it shouldn't be an issue.
I hope I'm not driving too much away from the topic, but I know when the central bank has surpluses of their accounts, they give their money to the government.
Yes.
What is the point of it? Does it might increase like governmental pressures of like the central bank having
Yes,
surpluses?
because like usually central bank is kind of owned by like a state. Its profit is transferred to the state, but because we want to, even if there is no economic reason and it's just political economy, we want to avoid this possibility or reduce probability of having negative equity in the future. That's why central banks usually accumulate some capital to some point, and only above this, whatever profit is generated, only above this capital position is transferred to the state. So that's kind of somewhere in the middle.
So you're not afraid by the fact that the government might pressure central bank to generate surpluses?
Like in normal cases, no. But if there is kind of a fiscal dominance, if central bank is kind of a like a not independent, then this can be an issue.
So can I ask
Yeah.
question? Do you understand that the expectations are somewhat reflected in forwards and futures? So how we see this expectation in the market in the forms of forwards and futures, yes?
Forwards and futures, you mean in terms of foreign currency
No,
interest rate forwards and futures?
in terms of it's a kind of mm,
Like derivatives market?
yes, yes.
Yeah, they will also be reflected in derivatives market, yes.
Where else they can reflect it if not in derivatives?
Like any long-term asset,
Yields?
any long-term asset would incorporate expectations of
But
future
in order
policy rate.
to avoid this arbitrage, like the only way that we can have this arbitrage to buy these forwards and futures and to do that arbitrage, yes.
You can also do arbitrage with long-term asset. Like this is an example on this slide. So this is imagine you are like thinking about 1 year investment opportunity and rolling it over for to another year, so that you are trying to invest your money for 3 years. That's one option. And if you want to kind of exploit arbitrage opportunity, you would also look at the 3 year investment opportunity. If you invest in something that generates like a return for 3 years at some fixed interest rate, because this is like we're talking about the fixed income, like government securities, other types of bonds, then you would. This is actually trying to trying to exploit arbitrage opportunities, even with simple like a fixed income, like a securities, government securities, even corporate bonds can also have similar thing. It's not just about derivatives market. It's like any asset that's long term. Like actually, even non-financial assets also incorporate some expectations of future interest rates. It's just that they have so many other components. Their volatility outweighs any interest rates impact, but in principle, they also have some impact of short-term interest rates. So any asset that's long-term, not just derivatives market, just simple assets that are long-term, they incorporate expectations of future policy rate. Like even apartments and can generate expectations of future policy rate.
But that's called arbitrage.
The arbitrage we call arbitrage when there is a clear dominance of one strategy over another. So if this interest rate would be 6% and expectations of policy rate are such, then everyone would rush to this 6% long-term asset, because the 6% would be much higher than the average of short-term interest rates over this investment horizon, which means that everyone rushing to this investment strategy would increase price of this asset, which means that its interest rate will decline, its return will decline. So, and that's what we mean by arbitrage, to push some like prices in in one direction that makes you indifferent between different strategies. That's basically what I mean by arbitrage. Okay, now let me a bit generalize these interest rate linkages, and let's think about what the loan interest rate depends on. Because as we discussed, loan extension, like lending, is that creates money in most of the cases. And that means that we want to understand what the loan interest rate depends on. So this is the part that we already discussed. Current and future expected short-term interest rates over like a capital T periods into the future. That's kind of if we assume that the loan is long-term over capital T periods, and the short-term interest rates over this whole like a loan maturity horizon will define lending interest rates. Interest rate risk or term premium will also define this loan interest rate risk. That's something that we discussed that gives us the like a close to risk-free long-term securities yields, like government bonds or like a very low-risk corporate bonds, sometimes even, depending on the credit worthiness. If it's like a close, if the default risk close to zero. So this is kind of something that we already discussed, but there is also other types of risk premium, which also finally result in lending interest rates. One of these risk premium is liquidity risk premium. So what is the liquidity risk premium? If you invest your money in some short-term kind of it's essentially asset. Like what I have in mind is bank deposits mostly. If you invest your money in a bank deposit, so you just decide to hold your wealth in the form of bank deposit, what is the risk? Like, and I mean term deposits. Like you decide to hold your wealth in the form of 1 year term deposit at the bank. So then the bank offers you some interest rate. So this interest rate is fixed for this 1 year period, which means that you are as much exposed to interest rate risk as you would be in case you held government securities. So these expectations of interest rate risk and expectations of interest rate and term premium still apply. But on top of it, there is a chance that when 1 year passes and you ask a bank, or even during this maturity, when you ask a bank to convert your deposit into cash, the commercial bank may not be able to do this. So this risk is usually very low, and it should be always very low, like close to zero, because central bank should have a framework such that this risk is never kind of a material, because we want to have, again, one-to-one convertibility between deposits and cash. But if there is some chance that some people fear that you may not be able to get your deposit on demand, then you incorporate this liquidity risk. So this liquidity risk is something that will have any asset that would be difficult to convert into cash. So any asset can have this liquidity risk, even including deposits if banks are not that credible, or and by implication, if central bank is not that credible. So that means that this liquidity risk is something that will define term deposit interest rate as well, if your financial system is not functioning very well. There can actually be some cases when government securities can also have liquidity risk if there is no active secondary market, and if central bank is not taking these government securities as collateral to provide liquidity against. So this is like liquidity risk is something that we have to keep in mind if we want to have this transmission kind of strong enough.
May I?
Yes.
Don't we assume that treasury bills are risk-free?
Yes.
Why do interest rate risk then?
So when we say, that's a kind of a confusing part, yes. But when we say risk-free, we mean risk of default. So interest rate risk is something that will always be on a long-term investment. But when we say it's risk-free, we are essentially meaning that there is a close to zero chance that the U.S. government will default on its own obligations. So it's kind of a default of credit risk. For loans, we do have credit risk because for mortgages, even when there is an apartment as kind of a pledged as a kind of collateral, there's still some chance that price of apartment can decline so much that this borrower will still default. And let alone these unsecured loans, which have like a very high credit risk. So credit risk is there. This also complicates the picture. This also complicates this link between policy rate and lending rate to be visible. Of course, other term premium also do the same stuff. When this like a risk premium like a fluctuate, it makes this link between policy rate and lending rate essentially invisible, even though that it's still there, it's always there. This volatility in this kind of a risk premium essentially can outweigh any impact from policy rate. And of course, finally, we have this interest rate spread. So essentially, we can think of any other variable that the banks take into account when setting lending rates. So let's throw everything inside this spread. So it will be, I don't know, like overhead costs, like operating a bank branches or like a profit margin of banks, which will depend on competition between banks and so on. So these are things that's in many cases beyond the control of central bank. So let's put them everything in one variable. So what we want to discuss now is what the central bank can do to make sure that transmission from short-term policy rate to the lending rate is strong enough. And which means that we want to make sure that this risk premium is as low as consistent with like a stable functioning financial system, and therefore this interest rate transmission will become visible. Yes.
So you didn't put country risk there because you assume it's equal in all variations in the economy, right?
Equal is what?
The country risk.
Yes.
Inside the country.
Yes, I don't have country risk here because we are essentially talking about like a domestic bank lending to domestic agent, which means that they are exposed to the same risk, so that it kind of cancels out this. But if we're talking about like a foreign bank lending to domestic borrower, then there will be a country risk as well.
Can you just clarify?
Yeah.
The T-bill is the treasury bill?
Yeah. Yes, treasury bill. Okay, let's start with the first part. Like this is kind of a sequence of reforms that usually like developing economies would need to take. Developed economies have already gone through this. Their financial system is already well developed, so that this is something that they may not be worried about. In their cases, that's why transmission from policy decisions to like a macro variables is strong. That's why they people don't really talk about much about this operational side, but that's not the case for countries like ours when we have to develop a financial system from like a very low levels of development. So the first part is essentially about the policy rate impacting even short-term interest rates. So we know that central banks have some, like instruments to affect short-term interest rates on the market. But if a monetary framework is not set up like a that controls the short-term interest rates, there are actually many cases when central banks set policy rate at one level, and in the private market, even short-term interest rates like are all over the places. It means that you can't have any hope that your transmission will work if your policy rate is not impacting even short-term rates. How would it impact long-term interest rates? So that's would be the first part, like taking control over short-term interest rate in the market, and this is actually the case for Georgia. And as you see, before 2010, when this new framework was introduced, short-term interest rates, like this is this blue line is actually one-day like interbank market interest rates that banks lend between themselves. And this was like much different from the central bank's policy rate, which is in red. Like difference, it was like sometimes more than 4 percentage points, which is like a very big. This means that even if central bank decided to do something with its policy rate, then it may not be reflected in lending and therefore money creation process simply because it has no impact on even short-term interest rates. So then the first step would be to take control over short-term interest rates, and that's done by doing monetary operations in a way that drives money market, short-term money market interest rates close to the policy rate. And this is like open market operations, buying or selling securities consistent with demand for liquidity. But sometimes you may miss demand for liquidity can exceed kind of your expected demand, so that demand can surpass supply, or demand can be lower than supply, like suddenly within one day. And to avoid fluctuations in interbank market interest rates too much, that's why we also have these kind of standing facilities. Standing facilities are essentially instruments of the central bank. On the lower side, we have deposit facility, which means that if like banks have excess liquidity suddenly, like government decided to spend money unexpectedly during one day more than was expected, so that there is more liquidity within the banking system, it would drive interest rates down because banks have too much liquidity. They are trying to lend between themselves, and if every bank is trying to lend reserves and nobody's there to borrow, then they will essentially reduce their interest rate so that someone will show up with who's willing to take these reserves at least with these lower interest rates. To avoid this too much reduction in short-term interest rates because of this kind of unexpected liquidity surplus, then we have this deposit facility, meaning that commercial bank, if it has excess liquidity and cannot lend to other commercial banks at like a reasonable interest rate that's close to policy rate, then there is a central bank that says that, I'm always there. If you have excess liquidity, you can always bring your excess liquidity to my facility, and I will give you policy rate minus something. And that minus something is usually small enough so that the short-term interest rates do not deviate much from policy rate. And similarly on the upper side, if like government decides to spend less, or if there is an increase in demand for cash, so that banks are kind of losing their liquidity, that means that banks will be trying to get this liquidity from other banks. But if other banks are also trying to get liquidity from the rest, then everyone will just simply bid up interest rate. Being hungry for liquidity, they will bid up interest rates on the interbank market. And to avoid this, then we have central bank that says, if every one of you is in like short of liquidity, and I'm always there, I will always give you liquidity at policy rate plus something. And again, that plus something is small enough so that interbank market rates do not deviate too much from policy rate. And once this system becomes more like a credible, that you see that these fluctuations in interbank market rates decline, because everyone knows that central bank has good control over short-term rates, and they never question this, so that even when they lend and borrow between themselves, now they always do it at exactly policy rate. So that's kind of a first step.
Just a question. So does always central bank lends to commercial banks at the marginal lending facility rates, or can it lend at the main refinancing operations rate?
So there are some slight differences in terms of frameworks. So this framework is what we call corridor system. So that we with our like a key instrument, like similar to open market operations, we have these refinancing loans. We try to provide as much liquidity to the banks as we think is consistent with demand for liquidity. So that's kind of something we try to, with one instrument, push short-term interest rates close to the policy rate. But if things turn out different than we expected, then we have this kind of a corridor to ensure this kind of a forecast inaccuracy risk.
So as a
But-
rule, you would lend at the main refinancing offer
Yes.
rates according to the amount that's
Yes.
necessary.
Yes, but if demand turns out to be higher, then we would demand that this a 1 day facility, 1 day lending facility. If demand is lower than we expected, then they will just park their liquidity at these commercial banks. So this is corridor system when we try to push interest rates inside the corridor close to the policy rate. But there is also kind of a different approach. For instance, the Fed, ECB, Japan, many central banks that have excess liquidity, be it because they did some large-scale asset purchases like QE, or they purchased large amounts of foreign exchange that also supplies liquidity. If they have excess liquidity system, then we are talking about this floor system when central bank's main policy rate becomes this lower part, so that this short-term interest rate decline to this lower part, so that everyone has excess liquidity and everyone is putting their money to the central bank at this lower bound rate, and then central bank is managing short-term interest rates by changing this lower part, and this lower part becomes the policy rate. In our case, the policy rate is in the middle. In other floor cases, policy rate is, as the name suggests, the floor of the corridor. But as long as both systems have influence on short-term interest rates, they are essentially equivalent, apart from some minor details. Yes.
Okay, so you mentioned excess liquidity. So if a commercial bank is raising excess liquidity, how is the CB going to take control of that? What kind of policy are they going?
We have a standing facility. Standing facility means that there is not even decision from a central bank needed. The standing facility is automatic. If a commercial bank has excess liquidity, it knows that within, in our case, it's like a Bloomberg system, whatever the software, they know that they can always kind of a push button and park this excess liquidity at the central bank standing facility, and they will get some certain interest rate. So, of course, there's a chance that central bank may decide to change the system. But as long as there's this approach from central bank is credible, banks will not be afraid of this excess liquidity. They will always be parking this at the central bank.
So the process is long, right?
Yes. And also credible. Yes.
So, do I understand it correctly? If, for example, there is an excess liquidity and over time it is getting worse, then the rate of the deposit facility will increase, right? In order to motivate banks to deposit their excess liquidity in the central bank.
So that can automatically, that's not something that would happen, but by kind of a decision of the central bank. I think what you have in mind is that if we are having a corridor system and suddenly we turn into excess liquidity system, so that interest rates are no longer fluctuating in the middle, close to the policy rate, and they inch down to the deposit rate and staying there indefinitely, it means that essentially you have eased your policy because interest rates declined by this amount. Like in this case, this is, I don't know how much, 1 percentage point. So 1 percentage point decline in interest rate can be considered as kind of easing. And if that's something that will continue indefinitely, then you may indeed think about increasing your deposit facility rate to undo any kind of easing impact from this excess liquidity. So that's something that you take into account when making decisions, but automatically that's not something that would happen. Automatic would be if there's excess liquidity always, interest rates will decline to this deposit facility rate and then stay there. Even if it's low, they will stay at this low level.
Why do you use the asymmetricity of the coding?
Yes, so that's kind of a specific case for Georgia because we have a tax exemptions. So when banks park liquidity at the central bank, they are exempt from tax. And when they borrow this liquidity to other commercial banks, they have to pay interest rate tax. It's like an income tax. So because of this tax rate differential, if this were not if this were symmetric, if deposit facility rate would be there, all of the commercial banks would deposit at the central bank because it has tax advantage. So they would not borrow, they would not lend to other banks. So that was an issue, and this became an issue more visibly when interest rates went up. So that higher interest rate multiplied by tax rate became meaningful. When interest rates were low, this was not an issue, but for higher interest rates, it became an issue. But now the actually tax code is being changed so that interest rate from central bank will also be taxed, so that this will become symmetric again.
But just to clarify, so the liquidity surplus in the banks directly into bank rates now, right?
Yes.
And the central bank interferes in this case to make the policy rate and the interest rate equal to each other.
Yes.
Sorry, we need to do all the interviews.
Yes. So let's break here. It's a good time to break so that we cover the first part of interest rate, lending interest rate. So let's continue in 15 minutes. Okay, let's continue. So we were discussing how central banks are trying to take control over short-term interest rates, because that's the very first basic part to get a hold of the money creation process. So now, when we say that central banks should be supplying liquidity as much as there is demand to make sure that market interest rates stay close to the policy rate, in this case, in the middle of the corridor, we need to understand what are the driving forces of demand for liquidity. So let me quickly go through this. We don't have to spend too much time, but there is kind of two major sources of demand for liquidity. One is demand for cash. When banks create deposits, then this means that some of the people may want to hold their money in the form of cash instead of deposits, so that newly created deposit may be converted into cash. So that creates demand for central bank liquidity. And the other source is reserve requirements. When banks create deposits, they also have to satisfy reserve requirements, which is like a certain percentage of deposit base. Actually, in some countries, reserve requirement is zero, which doesn't change much. Unlike the money multiplier approach, which would say that like a money supply would be infinite, because we know that money multiplier tells us that the broad money equals central banks printed money or base money divided by reserve requirement. But we know that in many cases, reserve requirement is simply zero. But of course, that doesn't change much in reality, because that's not how money is, broad money is really created. And there are some other factors like government operations or central banks, foreign exchange interventions, and so on. So let me skip this part and give you the broad idea how central bank uses its balance sheet. It's like a instruments, like direct instruments to control short-term interest rates. So the idea is that these bank reserves should be in the system as much as it is needed to satisfy banks' reserve requirements, not more, not less. Because if it's more, banks will try to invest these reserves in somewhere that may drive interest rates down. If it's less, then banks will be hungry for reserves and they will drive interest rates up. So that means that the operational kind of target is to make sure that bank reserves in the system stay at the level that's consistent with reserve requirements, meaning that banks will have neither shortage of liquidity nor surplus of liquidity, so that they will be indifferent at the policy rate. But there are some factors that impact these bank reserves, like liquidity. That's what we call liquidity in the system. FX interventions, some government operations, and what central banks are trying essentially, and also changing demand for cash also impacts banks' liquidity, because how banks are able to satisfy demand for cash, they have to draw down on their central bank like a liquidity holdings. They draw down these central bank reserves, go to the like a cash center of the central bank, and in return get like a physical cash, and then they give this cash to consumers, which means that commercial banks will now have less liquidity, and this all impacts banks kind of how hungry banks will be for central bank reserves. And then we have these other monetary operations, which act as kind of a residual. So the difference between this and all the other components is gives you demand for like a extra demand for central bank reserves, or it can actually give excess of liquidity. So central banks with these operations either absorb excess liquidity or provide liquidity if it's liquid in liquidity deficit. So that's kind of a broad idea, and this actually summarizes better in visual form. So this is balance sheet of a central bank, actually balance sheet of NBG, and two sides of the balance sheet. One is a liability side mostly, and the other is mostly asset side. But we have some items for liability side as well. But the idea is that reserve money is decomposed into two liabilities of the central bank. One is cash, and the other is banks' holdings of liquidity at the central bank. So this is essentially something that tells us what's demand for reserve money. and the other side, another side of the same coin, tells us another side of the balance sheet, tells us which items of the central bank's balance sheets, mostly asset side, helps us to back this liability side. So what we use to supply when there is this demand of liquidity, how we supply this liquidity. So we supply this liquidity through, in many cases, like in small open economies, this is in many cases through foreign exchange reserves. International reserves are one major asset that small open economy central banks hold. When central bank buys foreign exchange, it's essentially in return giving domestic currency liquidity to the system. So that's one way to supply. Then we have some other means, like government operations can also impact. And this blue one, in our case, is this residual that I was talking about. The residual that makes sure that this like a kind of a supply of liquidity always equals demand for liquidity. So that's kind of a basic idea. And when you have systems set up this way, and when banks, more importantly, when banks realize that this system is here to stay, and therefore the system becomes credible, then they don't question your ability to manage short-term interest rates, and then you have like a close to perfect control over short-term interest rates. So this essentially takes part of this. So we are trying to gradually build up the transmission mechanism. So we are taking care of this part. So the next one is first affecting expectations of the future policy rate, and also affecting the interest rate risk premium or term premium. So that would be our next stage in kind of building our transmission mechanism to have an impact on money creation. So let's talk about the expectations of policy rate. So this is what we have started in 2016. We started to publish our monetary policy rate forecast because we wanted to have a better influence over expectations of the future policy rate, so that we wanted to be explicit about what the market should expect about the policy rate. So yesterday, if you watched, we had this session with Yuri. We discussed how this scenario-based forward guidance that kind of is the bedrock of the FPAS Mark II is different. But this is essentially kind of a main idea of FPAS Mark I, that within baseline scenario that you want to communicate, you don't just tell the market what inflation is expected to be. That's not like a very good information from a central bank. What private sector essentially wants to see from a central bank is what central bank itself will do in the future. And therefore, we decided that when we provide inflation forecast, it's at least as much or even more important to tell what is the interest rate that results in this inflation forecast. Because we know inflation is endogenous and interest rate is also endogenous. So they are interlinked. That's kind of giving them full picture will give them better idea of what the policy is planning for the future. Of course, the challenge was for the market not to take this as a commitment to, for instance, declining interest rate by this amount. But we were very kind of explicit always, especially with financial markets, with banks, that this is not commitment. This is just our expectation given today's information. If new information comes in the future, and they always come in, then this trajectory will be adjusted. But still, it gives you some idea of how we would react if things go as in the baseline. So that's kind of that was the main idea, to impact expectations of the future rate this way. And it turned that it did have an impact. So this is what we saw. If you look at the yield curve back then, in 3 months after we published this policy rate forecast, the long-term interest rates declined quite a bit. Even though this short end of the yield curve didn't decline as much, because the short-term interest rates were essentially close to the policy rate, and policy rate has not yet been reduced that much. This short end declined only very little, but the long end declined quite a bit because market anticipated this expected decline in short-term rate, and therefore they reduced the long-term yield bits, so that long-term yields decline. So that's one reason. The expectations of the future policy rate had more impact on these longer-term interest rates. The other impact is the risk premium. Risk premium was that when we essentially communicated this interest rate trajectory, we were kind of essentially explicit that this is our major instrument, and we are planning on changing this policy instrument gradually in one way or the other. And therefore, they should not be as afraid of interest rate risk as before. Why? Because before this framework was introduced, before 2010, interest rate was not like a major instrument. Central bank was not paying as much attention to short-term interest rates. That's why short-term interest rates were all over the place, so that banks would be kind of afraid. What if next year central bank doesn't provide as much liquidity as is needed, and what if market interest rates shoot up to 20%? I would incur like a huge amounts of capital losses. But when we kind of were explicit that we are sticking with the interest rate instrument, this is what we look at. We will provide liquidity as much as there is demand, so that market interest rates follow our policy rate, and policy rate will move gradually. So that kind of reduced perceptions of interest rate risk, and actually as well as liquidity risk.
So can I ask a simple?
Yes.
Maybe it's a very simple question. Do you work only with financial sector? So only with banks and other financial institutions, or for with real sector as well? So only financial institutions are looking in your reports and talking with you, or other kind of institutions?
So in terms of who reads our report, I think it's mostly banks. Even within banks, there are only a couple of big banks are kind of read it in detail, I guess. There are also some like maybe big players in the real economy, like non-financial sector, like big companies may also be interested. Some we have a couple of journalists which specialize in economic kind of a news, and they also read our report, as I've seen. And also, I think big part of our readers is also international financial institutions. They also follow closely. So those are like major players in terms of reports. So that's why when we try to communicate our policies, most of the time it's with financial system, and within the financial system it's mostly banks, because we have a bank-dominated financial system. But sometimes we try to communicate with non-financial sector, like a real sector. Actually, we had this kind of practice that we used to hold MPC meetings in the regions of the country, in different regions. Every MPC would be in different regions, and we would meet domestic, regional businesses and journalists to discuss our policy decisions. But for some reason, after COVID, this kind of practice it was suspended. But yeah, I think it's a good idea to try to communicate directly to the real economy. It's a bit more challenging to convey your messages properly, because they may not understand concepts as well as big banks that have economists. But still, I think it's worth trying.
Like when you try to form the expectations, you try to form to the public, inside the public, or inside.
Yes.
Yes.
Yes. Yes. So actually, we also have short videos of a short summary of monetary policy report that's published on Facebook or on other types of social media, which shows that this kind of what's expected about policy, about inflation, like a simple narrative. Actually, the governor is talking about this in a couple of minutes of video. So that's kind of one way to address the general public. Yes.
So when we learn about interest rates, we learn about it like something neutral. So it's not a good thing, it's not a bad thing. But why in this example, the decrease in long-term interest rates is like considered a good thing?
So neutral interest rate is kind of a theoretical concept. So it's something that essentially ensures stability in the economy. What we're talking about is kind of operational side, actual interest rates. So actual short-term interest rate, actual long-term interest rate, but those actual interest rates may deviate from neutral interest rate. So neutral interest rate is model-dependent concept. So we would need a model to talk about this neutral interest rate and what interest rates in general should be in the economy to stabilize inflation, to stabilize output, and so on. So that's a bit different thing. Now we're talking about the actual part. So central banks' actual instruments and their impact on market interest rates. If we have these instruments set up correctly so that we control actual interest rates, then we can talk about what should interest rates be. And once we have instruments that affect market interest rates, and then we make our analysis, our modeling discussion, and decide that neutral interest rate is probably somewhere here. We need to increase interest rate or decrease interest rate. Then we know that whatever we decide through this kind of macroeconomic analysis, then we have means or instruments to enforce our decision. So now we're talking about these means through which we want to be able to enforce our decisions. So neutral interest rate is something that informs our decisions, whether to increase interest rate or decrease interest rate. And these are things that enforce these decisions, enforces it to have an impact on the actual economy.
So if we would like to lower longer-term interest rates, we need to use this method.
So this is the framework that essentially guarantees, well, maybe it's a bit strong word, essentially that helps us to have an impact on market interest rates. Let's imagine we met on an during monetary policy committee meeting. We made some analysis, and we decided that neutral interest rate is higher than we expected before. So let's increase our policy rate because we want to make sure that in the market interest rates are higher. That would make them consistent with higher neutral rate. So now the question is, okay, we decided to increase our policy rate. Will it have an impact on actual market interest rates? So that's the question. And when you have like the instruments or monetary operational framework set up this way, it helps you to have an impact on market interest rates. When you increase your policy rate, it will also increase short-term interest rates. If you communicate that you plan to keep your interest rate, your policy rate higher for longer, it will also have impact on long-term actual market interest rates, so that all interest rates in the economy may increase if your framework is like a functional. That would mean that your now market interest rates in the economy that became higher are now consistent with your view that this is what's consistent with inflation stability because neutral rate is higher. So that's kind of the idea. Neutral rate is kind of guiding us. These instruments are means through which we kind of push the system towards this guide. So it's like you can imagine, I don't know, like a ship that's guided by some stars, and you have instruments to like row the ship and then move the ship in one direction. So we are talking about these instruments to kind of push ship in one direction, but the star that's guiding us in which direction should we go, that's a neutral interest rate.
So with this like framework, the yield curve can like even increase if we want to.
So
it shifts down. Can it shift upward?
When it shifts down, it can also shift up, of course. If we had a forward guidance such that we would project that, in the future we plan to increase our policy rate. Most likely markets would have kind of adjusted their expectations of future rate upwards, and therefore they would have increased their long-term interest rates. So this is 10-year actual interest rate, so 10-year government bonds. How much interest they earn, how much is yield, how much return do you get on holding the 10-year government bond? That's interest rate, that's actual interest rate. That again can be different from neutral rate. And if it's lower than neutral rate, you would expect inflation pressures. If it's higher than neutral rate, you would expect disinflation pressures. Okay, so
Yes, do you take into account any measure of elasticity from the banks, like commercial banks? Because sometimes if the system is the anchor or you have a very small capital markets, the central bank will increase the interest rate on the companies.
yes, that can be an issue. That's an issue when central banks' decisions do not have an impact on short-term market interest rates, exactly because this operating system is not set up that essentially makes it clear for banks that they are incurring losses. So, yeah, I think you're correct that when financial system is not well developed, in a sense, not only in like a technological sense, but also when the financial market participants' mindsets are not well developed, like in a way that forces them to exploit all the arbitrage opportunities, they may not pay attention at all, even when you have these standing facilities. So when we are talking about here, actually, this was, I think, an example in our case as well. So even though we had these standing facilities, so this is average interbank rate. But during this period, there were some banks that were actually lending their excess reserves to other banks below this deposit facility rate. So apparently they were making they had free lunch essentially. They could move their money to the central bank facility and gotten the high rate. Or when they had a shortage of liquidity, they were borrowing from other banks at higher than the credit facility rate. So that's also kind of a free lunch. You could have borrowed from central bank at a lower rate. Yes, because it's like this underdevelopment of system and knowledge, lack of knowledge, can result in transmission breaking down. So that would be an issue. That's why we had like a very close cooperation with them, like telling them, that you're losing money for no reason, and like that implies some training of their staff, how financial market works. So that's a big part. So it's not just central bank like creating some instruments or standing facilities. It's also financial market participants should know how to behave, how to function. So that's something that can be an issue from the very early stages. Okay. So that's kind of a longer term part. When we communicate about the future interest rates, the aim was to kind of reduce the uncertainty about interest rates because markets were afraid that interest rates can jump up. Like if central bank is not providing liquidity as much as needed, they can jump up to around 20%. They can jump down to 0% if the interest rate is in excess. So once they got this confidence that our like a framework of interest rate targeting is there to stay, then interest rate risks decline. The other part was this short-term interest rate volatility. When you kind of manage liquidity in a way that stabilizes short-term market interest rates close to the policy rate, then they don't require as much term premium. And let's contrast it to before 2010. You see that interest rate volatility was huge because we didn't provide liquidity according to demand for liquidity, and therefore what's left if there is demand and there's unchanged supply, then price should change. If there is lower demand, supply is unchanged, then price will change. So price was fluctuating, and that meant that banks would incorporate very high term premium, even as short as 3-month interest rates, because like next month interest rate could be 20% or 0% the month after. That means that when you don't have this interest rate targeting framework, term premium is huge. So that was kind of one part of the reform, to reduce volatility of short-term interest rates, to reduce the term premium. So that essentially addresses these remaining parts, the expectations part and also the term premium. This lower volatility in market interest rates reduces this term premium. And the next part is liquidity risk. So what is the liquidity risk? As we mentioned, it's kind of if we think about deposits, when we have deposits, if financial system is well developed and banks are credible, we never really question banks' ability to convert their $1 deposit into $1 cash. Convertibility is so credible. Actually, most people don't even know that there's a difference. We would think that $1 deposit is $1 cash. We just have our money at the bank. But like in reality, we know that the deposit is a liability of the commercial bank, not of central bank. Cash is a liability of the central bank, but not deposit. But because we have a credible financial system where a central bank is guaranteeing this liquidity risk and one-to-one convertibility, that means that there is like no questions asked about this. But what if there is when that can be an issue sometimes when there are some like signs of bank runs. Bank run is essentially nothing more than kind of people realizing that liquidity risk is so high that one-to-one convertibility is questioned, and now you realize that your $1 deposit needs to be quickly converted into $1 cash before others make it before you, and then bank goes under. So that's kind of a liquidity risk. And the way to ensure this liquidity risk is by central bank to provide liquidity as much as needed to ensure this kind of a one-to-one convertibility. But there is one constraint that central banks face, and that is collateral. How much liquidity central bank will provide to banks will depend on how good collaterals banks have. So that was a kind of a big issue for us in the early years of the inflation targeting reform, because risk-free securities were not, like, portfolio was not big enough. Even if these mostly government securities was held by banks, it was like a tiny portion of like a GDP or like overall economy, because government usually borrowed from abroad, from like donor funding, bilateral or multilateral international financial institutions, which was like mostly in foreign currency, which is kind of a, which means that domestic currency close to risk-free assets were like a very scarce. But gradually, the government started to switch to domestic currency borrowing, and the portfolio of government securities increased. Now it's like sufficiently big enough, the portfolio, so that we have this like close to risk-free assets that banks can use to obtain liquidity anytime from the central bank. But in the meantime, because this was not like a big enough, we also incorporated some other types of assets into our collateral base that we would expect as collateral to give liquidity to banks, like corporate bonds or even sometimes loan assets. When banks extend loans to borrowers, like mortgages, if these mortgages are like of good quality, some part of it we would expect as collateral to give liquidity to banks. So that was kind of one way to reduce liquidity risk. So this is our collateral base. So this part is like operational all the time. So this is like usual, like everyday business. We accept these assets as collateral and give liquidity against it. But there can be some special circumstances, like COVID crisis. During COVID crisis, we extended our collateral base to include things like small and medium enterprises loans, like SME loans, which was not part of a collateral base and is usually never part of collateral base, because central banks try to avoid assets as collateral which include credit risk. So central banks should not have credit risk on their balance sheet. But under like a special or like circumstances, then this may be considered if liquidity risk is increasing too much. And also there is this ELA, which is emergency liquidity assistance. When if bank is assessed to be solvent, it has like assets, long-term assets that are like expected to pay off, but they are very liquid. then we may still decide to give liquidity to banks if we think that solvency is not an issue, but it's just liquidity is an issue.
Can I ask?
Yes.
What was the reason that you extended that collateral basis during the COVID? Is there any need for the liquidity?
Yes.
Or
So during COVID, what we observed was during the early phases, many people rushed to banks and the demand for cash increased. I don't know what was the reason. Most likely, the reason was that because of the lockdowns, they will not be able to get cash when they need it, so that they did it in advance. Or maybe they had some questions about whether their deposits can be frozen, or I don't know what was the reason, but the fact was that demand for cash increased massively. And when banks saw that they are now running short of liquidity, what they did actually, they started increasing deposit interest rates, term deposit interest rates much higher than policy rate. And that's essentially liquidity risk. That's this. When banks are seeing that deposits are flowing out, and they are having a shortage of liquidity, then they started increasing term deposit rates to kind of contain depositors not to cash out. And that means that essentially
yeah,
some of the conditions, some of the interest rates in the economy increased, even though we didn't change policy rate at all. So that was kind of a complicating this transmission mechanism. That's why this liquidity risk is usually close to zero, but like in stress periods, it can pop up, and you need to be mindful of this because this can also mess up this transmission. And the other part is credit risk. So let me not spend too much time on this one because credit risk is like a borrower specific. But there is also like a common factor, as we discussed this week. Common factor is like a common risk source of credit risk. Something that we also need to try to deal with if it's like a central bank related or like a macro management related. One example is dollarization. If dollarization is too high, then it means that you are exposed to exchange rate risk. If many people have foreign exchange loans, any real depreciation that may be necessary for external adjustment will be very painful because those people that have borrowed in foreign exchange, then they are now seeing deterioration of their disposable income because they have to pay more in real terms. They may have to assign more of their income to repay their loan, their foreign exchange loans, which means that if depreciation is big enough, it can result to like a financial stability concerns, so that becomes like a systemic issue.
why in that case we call it credit risk, not exchange rate risk?
Yes, yeah, good point. Like a full name would be currency-induced credit risk. That's how they call it. Even though banks don't have exchange rate risk per se, because they have foreign exchange loans as well as foreign exchange liabilities. So on their balance sheet, the book is hedged. Like they have equal amounts of foreign exchange assets and foreign exchange liabilities. But if those foreign exchange assets or loans are given to borrowers that have income in domestic currency, then these borrowers are unhedged and they are exposed to exchange rate risk. So their exchange rate risk can result in them defaulting on bank loans, and that's a credit risk for bank. But you're right that it starts from exchange rate risk. So that's why they call it currency-induced credit risk.
If the assets or liabilities in foreign exchange in certain bank is equal to each other, the risk of exchange rate cancel out, yeah? Because
Yes. Yes, for banks, there is no direct exchange rate risk, but there is indirect one through borrowers. If borrowers default, and that's a bank's problem. And then through the prudential regulation, we also want to reduce these financial stability concerns so that they don't impact, we don't have as small systemic risk component as possible. So actually, this is an NPL figure from Georgia, which shows that supervision regulation is kind of a relatively conservative, so that NPL is quite low. So non-performing loans are relatively low. So this kind of partially addresses credit risk. We cannot eliminate credit risk, of course, but at least reduce it as much as feasible through macro policies. And of course, there's this interest rate spread, which we bundled everything that's left beyond these components. Those are things that we don't have much control over, like we discussed, like efficiency of banks, how they operate, how many branches they need to operate. If they improve their efficiency, they can actually switch to online products that can reduce costs, that can reduce lending interest rates. If there's a more competition between banks, that can also reduce profit margins and so on. But that's something not really much related to our macro policy instruments. So again, let's summarize these parts. We have this kind of framework to think about how our decisions feed into lending interest rates to affect credit and money creation. There are some things that can complicate this transmission or sometimes make this transmission invisible. Like you can have some changes in the policy rate that we know if like a monetary operational side is well developed, should have an impact on lending interest rates, but these other components can change in a direction that masks this impact. So that therefore we may not be able to like empirically see transmission, but if we know that in these steps things are working well enough, then there should be transmission. If you compare to counterfactual, so if you increase interest rate and some of this risk premium declined, then lending interest rates may not change at all. But it doesn't necessarily mean that your higher policy rate has been ineffective. It means that if you had not increased your interest rates, lending interest rates would have been lower. So relative to counterfactual, we know that transmission would be there, but empirically, and like in data, we may not see it because of all the other components, and including about the expectations of the future policy rate. If I increase my policy rate today, but the market expects me to reduce it again, these two forces may cancel, and therefore I may not see much of an effect on lending interest rates. So that's actually something to. So if we, okay, we have some time, and let me quickly cover one part, and then we take a break. So yes.
So we talked about the liquidity risk. What about the expected liquidity risk? Because especially during the COVID times, when we had low credibility, I think people just expected low credibility. They kind of lost the trust in the banks. And I just want to ask, isn't that kind of a factor leading to expect the liquidity risk, not just general liquidity risk? So like credibility and liquidity risk are interconnected, and in that case, credibility kind of decreased and liquidity risk increased, right? The expected liquidity risk.
Yes.
So why do we talk about the liquidity risk and not the expected liquidity risk in this case?
Yes, so that's something that I include in this. So this liquidity risk is something that's over this whole capital T horizon. So liquidity risk, any time within this kind of maturity, anytime at any point, if there is a chance that banks may not be able to satisfy deposit outflows, that would kind of force me to ask for higher interest rate on deposits. That would be liquidity risk compensation. And you're right that mostly it's about expectations. It's not that I expect bank not to satisfy my deposit withdrawal request today. If it's today, we know that bank is already like a default in a default mode. It's always about the future. If I expect that in the future bank will not be able to satisfy my request to like withdraw my deposit, that's a risk for you for which you require compensation. So that's why in COVID case, term deposit rates increased by about 3 percentage points, which is huge. Actually, it was a time when we were starting to reduce our policy rate because of COVID recession. Okay. So these are some of the interest rates that we look at. And if you, let's start on the like a shorter maturity assets. So on the left-hand side, we have our policy rate and these 3-month, 6-month, and 1-year interest rates. So you see that before this kind of approach to interest rate management and before this risk premium was reduced as much as was kind of consistent with like a efficiently functioning financial system, these interest rates were kind of deviating too much from one another. You see that there were times when one interest rate jumped up, even though policy rate didn't have much of a change, and there were some times that they diverged again, or sometimes interest rates were declining, even though we were kind of starting to increase our policy rates. But afterwards, you see that they moved together. As long as there was no like expectations of big changes in policy rate in the near future, these interest rates remain close to each other, because if you don't expect your policy rate to change in the future much, and your term premium is very small, then these interest rates, because they are kind of close to short-term interest rates, they move together. And the exception is this period in 23, when we were keeping our policy rate higher. But this was the time when financial market decided that inflation problem has gone away. We've essentially stabilized inflation. Actually, inflation went below target. And now is the time for the central bank to quickly cut interest rates. And therefore, they started to incorporate these expectations into their kind of yields. Even short-term yields went down, meaning that over like a 1-year horizon, they expected big cuts in policy rate. So for some time, we're kind of standing ground, saying that, we want to make sure, and this is again consistent with risk management principles, we want to make sure that inflation problem is really has gone away, so that even if inflation undershoots target, we are okay with it, because we want to make sure that people are not afraid of high inflation risk scenario. That's why we kind of held this ground. But at some point, we realized that it is sufficient. And then we started cutting rates, and actually cutting rates quite rapidly. And now this rate is consistent with market's expectations. So in some sense, market expectation was correct. Maybe a bit delayed, but it was correct. So that's kind of a short-term part. The longer-term one, it's a bit tricky, because as we discussed, even when you just look at the risk-free assets that have no credit risk or no liquidity risk, they still have this interest rate risk, and they also have expectations of future policy rate. And when we're talking about the long periods of time, these expectations of future policy rate can be anything. So that's why this transmission here is not that much visible. But in some cases, it still is. Of course, I'm not talking about this pre-2016 episode, because we had like a very difficult to explain movements like increases and declines, not related at all with policy rates, or at least there were these expectations were off. Here, when interest rates were coming down, essentially realizing that policy rate expectations are coming down, that was the episode when we had like a major tightening phase. So that's something different. But after this, so they kind of move together, but sometimes they diverge. Most likely, I would presume not because term premium has been like fluctuating too much, but because of policy rate expectations. So an example would be this. This is again the same as there. These yields have declined, anticipating these future declines of policy rate, and again, exposed, they were right, because we did decline policy rate quite rapidly. But later episode is also interesting that long-term yields have gone up, even though we are in the kind of a policy easing cycle. And that's interesting because this is actually consistent with the narrative that we had in the latest press release. If you look at like a long-term indicators of long-term inflation expectations or long-term risks of the economy, they have increased somewhat. Inflation expectations have edged up a bit, but also country risk premium has increased because of we had some like a political turmoil, and that pushed risk premium, sovereign risk premium up. and also created some depreciation pressures. And banks essentially realized that easy policy in this environment may not be kind of optimal, so that they essentially revised up their expectations of future policy rate. So you see this jump up in the long-term yields, even though we are reducing policy rate. But if we know how transmission works, then we know that this doesn't mean that our policy rate is not effective. It means that other factors like expectations or risk premium have changed. Yes.
Why do you want to have different terms, term borrowings in the same rate? Because it's normal for the yield curve to different terms to have different maturities.
Yes.
So why do you want them to be aligned? Not
Uh,
close?
we don't want them to be aligned per se, because we know, again, if you're talking about a 5-year bond, this is different. So we are looking at just 5-year expected policy plus 5-year term premium. Because over 5-year, interest rate risk may be a bit lower than interest rate risk over 10 years. So over 10 years, this will be a bit different. But this is also looking at policy rates beyond 5-year for the next 5-year as well. So that those two parts, these extra 5-year policy rate expectations and some slight changes in term premium, this will drive those two yields different. So that 5-year yield and 10-year yield will indeed be different. But it turns out that in most of the cases, they're not too much different.
Sheldon, you could bring back that equation, maybe you can explain it in Martina by referring back to the time when you started to publish the expected path, the policy rate. So when you mean aligned, for example, if the market's expectation of the future path of the policy rate is inconsistent with what you're doing with monetary policy, and if you were to reveal the information to the market about how you're thinking about it, could be that it falls into line.
Yes.
Okay, so, and that depends on a judgment about how firmly you believe in your own view of the fundamentals. So maybe you can talk a little bit about that, because
yes, that's exactly the point. Here, the expectation was most likely that we may not either reduce policy rate as much, or we may not enforce it on the market interest rates. So that interest expected path of the policy rate was not as low, neither was the interest rate risk. But by publishing this, we were essentially, so the idea again was to show the central bank's reaction function. So when you reveal this information, you are telling them, with this inflation, we think that our own policy rate that's consistent with this inflation forecast is this, which shows gradual declines in the policy rate, which is something that financial markets may not have thought before. So that now revealing this extra information, they realized our reaction function is such that it results in lower interest rates in this baseline forecast. So that they revised down their expectations of future policy rate, and therefore they revised down these long-term yields. So when you have such a kind of a divergence between what financial market thinks your reaction function is and what you actually have, what your perceptions are, how you should be making decisions, then revealing this information can have a meaningful impact on market expectations. So I think that was the idea.
Now, it's really important to understand that there's two aspects to that argument. One is the central bank's views about the fundamentals. And since the central bank doesn't have a perfect crystal ball, you don't necessarily want to tell the market, revise interest rates down. I'm committing to lower interest rates, because that would be underpricing of risk. That would be the problem of the Fed and all the advanced economy central banks. The kind of forward guidance that they did was to tell people we're going to keep interest rates low for long. And that's a very dangerous policy, because if it's successful at stimulating the economy, there's going to come a day when you have to exit from it. And if you don't have a framework to exit to, like the Bank of Japan doesn't have, like the ECB doesn't have, like the Bank of England doesn't have, on that day when you have to exit it, like during taper tantrum or something like that, then all these, term premium can rise. So
Yeah.
when Sheldon talks about revealing the interest rate reaction function, he's not referring to the information about how the central
Yes.
bank views the fundamentals. He's referring to how the central bank is going to change the interest rate in the future, conditional on its view.
Yes.
So
exactly.
the market could still disagree completely about differences in fundamentals, and that's healthy. That's what we want. Right?
Yeah.
So we don't, to come back to your question, Martina, was an excellent question. You don't want them to necessarily align, okay? You want them to align if the difference is a result of a lack of transparency about monetary
Yes.
policy, okay? So that's fundamentally what the idea is. That's a
Yeah.
really good
Yeah,
question.
exactly. That's the point. And when uncertainty is high, this disagreement is more likely, so that it becomes even more important to, instead of telling them what the policy rate will be, to tell them how you would react to different types of scenarios. So that's why today it's becoming, this scenario-based forward guidance is becoming more relevant. Because when you show them, Chuck, like a interest rate trajectory in a baseline scenario, you are providing something that conflates state of the economy and policy reaction function. So this interest rate trajectory is essentially a function of those two. But we want only reaction function to be provided to the financial markets, because state of the economy, that's something that financial markets have different views about. So that's kind of a tricky part, to disentangle these two parts and just make financial markets understand what is your reaction function without imposing on them your own view of the state of the economy in the future. So let's break here, and then we continue. Okay, let's continue. We have a couple of slides left that would summarize what we discussed about interest rate transmitting to different types of interest rate, like policy rate transmitting to different types of interest rates in the economy, and therefore affecting the credit and money creation process. So we've discussed this, how policy rates may be linked to the yields and how this link may not be visible in data because of these other factors creating this divergence, like expectations of future rate and also some kinds of risk premium. So after yields, I think it's a good idea to also, as an example, look at the term deposit rates and the policy rate. So in our case, we had term deposit rates that was usually somewhat higher than the policy rate. That seemed to reflect some of the factors. One factor was this liquidity risk. So apparently, people holding their money in the form of term deposits uh, deem this to be kind of a relatively riskier means of saving or holding your wealth, and therefore they asked for higher interest rate as a compensation for this risk. And particularly interesting, something that we emphasized was this episode here when we were essentially reducing our policy rate. This is COVID period, but the term deposit rates actually increased quite a bit, which was this reflection of demand for cash and banks responding to this demand for cash by compensating depositors by higher interest rates so that they don't convert their deposits into cash. But that can kind of show you that link, like if you econometrically, if you try to regress this term deposit, and if you had these kind of episodes several times in history, and you would see there is a negative correlation between policy rate and deposit interest rates. But we know that it cannot be true because there was some other factor which is difficult to measure. Like maybe it's like close to impossible to measure exactly what is the liquidity risk premium, because there's, apart from liquidity risk, there's other types of risk premium as well, so that they are kind of bundled together in one interest rate. And if you don't have like a good measure of liquidity risk and you don't use these as kind of observable, then you would be forced to think that there's a negative link. But we know that there's not a negative link. It's just other third factor is driving this.
So do I understand correctly, if you haven't declined the policy rate, the effect of term deposit rate to increase will be much profounder?
Yes, exactly. So if we had not reduced our policy rate here, deposit rates would have been higher. But because counterfactual is something we cannot observe, we cannot really estimate anything based on that, because it's like counterfactual. It doesn't really exist. It's just our like a thought experiment. What would have happened if things were different? So that kind of complicates this. So after this, we had some kind of actually changes in regulation that also impacted this difference, and that's something that I have not mentioned. That this, what we said, that all the other parts that affect interest rates are bundled into one term that we didn't discuss much. It also includes regulatory parts. An example is that we introduced regulation that kind of incentivizes banks to de-dollarize their deposit base, and therefore they would be willing to charge higher interest rates on Georgian lari deposits, even if policy rate is lower. So the idea is that banks have some like reserve requirements, just like for domestic currency, they have reserve requirements for foreign currency. But foreign currency reserve requirements in our case is essentially prudential measure, not monetary policy measure, because on required foreign exchange reserves, we do not pay any interest. But banks, if banks were able to use this money and invest it in, I don't know, Fed treasuries, US treasuries, they would have gotten like maybe like 5%. Now they are getting 0%. So because they are forced to keep these reserves with us, on which we don't pay interest, meaning that they are essentially having a tax on their foreign exchange deposits. That's why, and then we say that we would reduce for each bank reserve requirement on foreign currency deposits would be lower if this particular bank has lower deposit dollarization. If this particular bank is more active in attracting domestic currency depositors, so that it's kind of a cross subsidy. If you attract domestic currency, one additional domestic currency depositor, then you see your cost declining for all the other depositors you have. It's kind of a cross subsidy, which makes banks much more incentivized to kind of de-dollarize their deposit base. So that means that they are willing to pay higher interest rates on Georgian lari deposits, even if that means this kind of spread widening. So again, another example that this link may not be visible, but we know relative to counterfactual, this link is still there. Yes.
So in the graph, when on September 19, the policy rate increased like 2%.
Yes.
And then the term to depositors started to increase, but the reaction was much slower. I mean,
Yes.
it took time to react. So that's because like the depositors start to think about their deposits to put money in the bank. Is that the cause of
yes,
reaction?
depositors are starting to realize that they are not getting as much as they should be, and if banks see that because of this deposits are flowing out, they will start increasing interest rates. Until they see pressure from depositors, why would they increase interest rates? So that's their interest cost. But that's why, because banks are like a quicker to realize changes in market interest rates, but the rest of the economy they take time to kind of realize that interest rates have changed, and they have to kind of push. They have to reallocate their like portfolio in a way that results in this portfolio earning higher interest. So that's why depositors take time to kind of force banks to increase deposit interest rates. That's also an issue. That brings some transmission lags as well.
So if do you understand it right, that the loss that they make to pay while they are paying higher interest rates on deposits, they are earning this loss from the foreign investment funds? Like,
So I'm not sure if I understand the question. So are you comparing?
They are making loss, yes, when they are paying higher interest rate on
Yes.
on,
And the question is, why would they increase deposit rates? Because it's a cost to them.
and they earn that costs on their foreign investment, that you decrease the reserve requirement for foreign reserves. They drive
Yeah, if you mean this episode when interest rates were kept, like term deposit rates were kept higher, even though we reduced our policy rate, the explanation here that we had was because when banks retain Georgian lari deposits, they have a lower cost of foreign currency deposits. And therefore, because it doesn't matter for a bank where cost comes from, if it's a cost, it's a cost. They want to minimize their costs overall, and therefore maximize their profit. So that if they find it profitable to pay slightly more to Georgian like a lari depositors, and by this keep their deposit dollarization at a lower level, this implies, by our regulation, this implies lower reserve requirement ratio applied to all the other FX deposits. So all the other FX deposits become cheaper for banks to service. So that reduces their overall costs. So that was one explanation why there was this kind of a slight divergence. There's also this kind of a divergence sometimes between policy rate and the longer term mortgage rates. We may not be able to see like visibly the link between this policy rate and mortgage rates, because we care about mortgage rates because they impact lending decisions and therefore they impact money creation process. But this link is not as much visible. Of course, it would not be visible before 2016 when the operational side was not that much developed. But even after that, when operational side was kind of more or less working properly, then we see some episodes when there can be some divergence. Of course, there are some episodes when they move together, like 2019 when we had to tighten policy, mortgage rates also went up, but there are some episodes when there can be divergence. Like for instance, here, when mortgage rates declined only slightly, but policy rate declined considerably. So one explanation is that maybe when we increased our policy rate, mortgage rates didn't increase as much, and when we reduce policy rate, they didn't decline as much either. So why wouldn't they increase in the first place? Well, maybe because market thought that this tightening of policy rate is temporary. So in the long term, policy rate will decline again. And because mortgages are like a long term loans, like usually they're like 10, 15 years long. That means that over 15 years, if they expected policy rate to come back down again, they wouldn't react as much. Of course, there was some slight increase because short end of the this maturity, like the short term of the yield curve, did increase. But the longer one, they didn't adjust as much.
Shall I have a question?
Yes.
It's a difference on the interest rate between the interest rate on mortgages and the interest rate on deposits. It's very small compared to other advanced economies, for example. What could be the reasons for that?
This spread between these two rates.
No. The difference between the interest rate on mortgages and the interest rate on term deposits that you showed as before. It's like they're almost not the same, but like very similar. I think the deposit was like over 10% and mortgage was also below 15%. It's very small compared to other countries.
Yes, it is.
Why is it the case? Why so banks don't make that much profit, or do they have?
They don't make that much profit. If you remember, yesterday we had this slide when we said that banks' profit is one, comparing like a long-term interest rates on their asset side versus long-term interest rate on the liability side. That's kind of an intermediation price, like finding long-term borrowers and long-term investors. But there is another source of profit, which is this long-term interest rate versus current account deposit rate, which is essentially zero, kind of what we call similar to seigniorage. And that's something that banks make profit from. In this case, term deposits are like a relatively small part of overall deposit base. Like a big part of deposit base for banks is current account deposits or demand deposits that have like a very low interest rates. So on that, they make much more profit.
Yeah, that makes sense.
Yeah.
Sure.
Can the demand for mortgage loans be the reason that it kept like horizontal? So, for example, starting from 2022, because of war in Ukraine, there was a flow of relocants, and thus they would like to have apartments or houses in like other countries, and they are taking mortgages, and because there are like people who are ready to pay for that mortgages for those loans, the banks don't want to like lower the rate.
Theoretically, that can be an explanation that if there is more demand for mortgages, banks why reduce mortgage rates when there is people who are accepting higher interest rates on their mortgages. But like in our case, at least, I don't think it's mostly like migrants that take out mortgages. Usually, they when they migrate, they have some wealth accumulated of their own, and they directly buy apartments without mortgages. So that it's still mostly domestic residents that create demand for mortgages, and on that front, nothing much have changed, except for nominal inflation of the economy. Like nominal economy increased, both real economy, like a real GDP increased, as well as inflation was high, so that nominal income in the economy was higher, meaning that there was a kind of a less leverage compared to nominal GDP, and therefore more willingness for people to be more kind of active in terms of planning their mortgage, like lending and borrowing and buying apartments, because nominal incomes are higher and they are less concerned about future income. So that part of demand does explain this. Yeah, but the other part is just expectations of policy rate, because expectations of policy rate over like 10, 15 years is something, this average of future 15 years of policy rate is something that changes only gradually, because by definition it's an average, and average over that much period of time is very smooth variable. That's why this kind of changes also gradually. But again, that doesn't mean there is no transmission. We know that there is a transmission because these other factors are just masking this transmission. So that's why it's so difficult to estimate transmission channel, even when there's every reason to expect that there should be transmission. Lucas?
On the previous slide, could it be the case that transmission is so minor because a big portion of mortgages are denominated in dollars?
This is mortgages in Georgian lari only, so only domestic currency. So these are business loan interest rates relative to our policy rate. Here, transmission is a bit more visible because maturity of these loans are somewhat lower, like maybe a couple of years, so 5 years maybe. But usually these business loans are not as kind of a long term as mortgages, and therefore the shorter part of the yield curve affects more these interest rates than the longer part. Of course, there are some interest rate risk, some other types of risk premia that can complicate this picture, but it seems these business loans are relatively low risk, because this includes corporates mostly, like in terms of volume of loans. So corporates are a big part, which have a low risk because they are big corporates and have bank relationships, and banks know them, and they don't charge much credit risk, and credit risk is not fluctuating that much. So that's why in this case this link is more visible. You see that in major tightening or easing phases, those rates have been moving in the same direction. One thing that's important to note is instead of looking at the dynamics, also comparing these regimes or episodes. Like before 2010, you see the spread between like business loan rates and short-term money market interest rates was like 17%. Now it is like close to 4%, which is essentially saying that this development of financial system and monetary framework led to big reductions in all sorts of risk premia, be it like interest rate risk premia, which used to be like a huge liquidity risk premia, also credit risk, like systemic risk of the economy is probably much lower than before. And maybe banks' efficiency has declined, so that spreads have declined, and hopefully the competition in the banks is higher, so that profit margins are lower. So all these reforms have resulted in this spread being lower, and also this movement being more visible. So to summarize these charts, it's important to note that if you understand all these components of transmission mechanism on the operational side and they are working efficiently, then you know that transmission should be there, even if you don't see it in the like a long-term risky interest rates, because we know that there are these other parts of these interest rate drivers that may complicate this picture. That's why empirical estimations are difficult to estimate transmission channels, and we have to be mindful of that. So to summarize, before we move on to the task that Doug wants us to do, to summarize, once central bank operational framework is set up in a way that has a like a meaningful effect on interest rates in the economy, we know that transmission should be there, and that's our hope to affect broad money aggregates. if that's something we want to affect, because they may have some demand pressures and inflation pressures. Therefore, this kind of a price of liquidity, or maybe it's more correct to say that like interest rates in general, interest rates that central bank affects in general, these are instruments that, or like ways to affect this credit extension and therefore money creation. This is also a kind of a view, like a way through which crowding out, this so-called crowding out happens. We know that in textbooks, because of this loanable funds theory, we are taught that when government borrows, the government takes out these loanable funds, and there is less left to be lent to private borrowers. And this is shown to be close to mechanic result, because if you take out something and there is less left to others, then you have automatically you have crowding out. But in reality, crowding out happens only indirectly and only if central bank reacts to it. How if government spends money that it doesn't have collected from taxes, so that we have deficit spending, it creates money supply, it creates inflationary pressures, and if central bank reacts to this by increasing interest rate, then private sector will take out less loans, so that less credit extension stabilizes this money, or like a nominal demand in the economy, and stabilizes inflation. So at the end of the day, we got this crowding out because government forced the central bank to tighten policy. But in principle, if we have fiscal dominance, if government forces central bank not to increase interest rate or not to tighten policy, we may not see any crowding out effect. We may actually see like a simultaneous expansion of government deficit spending as well as credit. Because if nominal economy is expanding, banks may extend even more loans. So that would generate in like a macro instability, of course. But that's a possibility. That's what happens when we have when we don't have independent central bank. So that's still another example how this kind of not understanding how money creation works can lead to some misconceptions about how the process affects how process works and how it affects central banks' decisions, or how central banks should deal with these different problems that can arise during this process. Even though final outcome is the same, crowding out happened. The final outcome can be the same, but the process is different. And usually the problems arise during process, so that's why we want to understand how the process works. Okay, so that's all from me. Doug, now the floor is yours.
Well, I just wanted to say that if you understood 50% of what we covered in the last 3 days, you would be way ahead of anybody at the Bank of England, way ahead of anybody at the ECB, way ahead of anybody at the Bank of Japan, and so on. Because the reason is that back before we started developing these FPAS frameworks, okay, we thought of policy. In fact, I heard an academic in the research part make this mistake. We used to think of policy as the policy rate, okay, and that policy rate is in some cases a 2-week repo rate. Sometimes it's even shorter than that. That repo rate is irrelevant for most economic actors in the economy. And so that was back in the days when monetary policy was say little, let action speak. So you decide on the policy rate, and then you wouldn't say anything. Monetary policy now is focused on expectational channels, trying to influence market rates by telling them about monetary policy and how monetary policy is going to respond to certain things. So Bank of England, ECB, Bank of Japan, those non-FS central banks are still stuck where we were, in the late 1980s in places like the Bank of Canada and the Reserve Bank of New Zealand and all these smaller central banks. So that's the first point, that what's special about the FS central banks is that they're trying to be more transparent, okay, to improve the efficacy of the monetary policy transmission mechanism. So that's point number one that you should get from this lecture. Second thing is, it's complicated when you look at the transmission mechanism, you need to have an analytical framework to understand all this stuff. The good news is that it's less complicated in advanced economies. So a lot of those terms, like the liquidity premium and so on, they're not really going to come into play unless you're in a crisis. So for example, like the global financial crisis, the most liquid financial markets in the world, shut down, okay? So, so I'd say the two most important points of the presentation is that the expectational channels are really important for you to think about and to define what monetary policy actually is. It's not the setting of the policy rate. It's using the opportunity to set the policy rate to communicate monetary policy, okay? So that's the first point. Second, when you talk to central banks, they will make this very common mistake, which is they'll say the transmission mechanism isn't working. You'll hear that over and over and over again. And in many cases, the implication that they'll draw from that is, therefore, we shouldn't take stronger action, that it's not working. So therefore, and that, of course, is harebrained in most cases. If you think that the transmission channel is not working, in many cases, it means that you have to be more forceful in changing your policy instruments to get the desired implications on market rates to affect the economy. So those were the two most important points that I got out of that, okay? Since we're gonna be working on the US economy this afternoon, I wanted to get Anahi up there, like get your computer up there and take you guys through Fred, okay, so that we can show you historical estimates of the term premium, so you can see what drives term premium in advanced economies like the United States. It's not the liquidity premium story that Sheldon was telling for interesting economies like Armenia and Georgia. It's mainly driven by perceptions of inflation expectations. So people think inflation is going to be higher in the future. They think that interest rates are going to be higher in the future. They demand a term premium and so on. So, but we also want to show you Fred, okay, for your presentations. And I want you to focus on your presentations until 4 o'clock. In other words, we're going to give you a sensible case A and case B.
to 2007. Okay. And over that period, the term premium was approximately 1%. Okay, so what does that mean? It means that market participants required a 1% term premium on 10-year bonds, okay, to compensate them for the risk that interest rates could go higher. Because if interest rates go higher and they buy the 10-year bond, if interest rates go higher, they're going to suffer a capital loss on those bonds. Okay, so when you think about the term premium, it's really a compensation for the possibility if you lock into the bond, the 10-year bond that has a fixed interest rate, and interest rates rise, you're going to suffer capital loss on those bonds. So 1%, you would say, yeah, it's pretty modest compensation for interest rates. You go back to before 1995, okay, and maybe what we'll do now is show you how to put another series on the chart. So let's put on a measure of inflation and so on. So what she's doing, go slow, Anna, you can show them what you're doing here, okay? So we have a graph in Fred, and we're going to edit the graph. And then we're going to add a measure of inflation. So or add core PCE or sticky price inflation, add your favorite measure of inflation. So the PCE obviously is what the target is expressed in. Okay, so now just plot it over the period where they both exist.
Oh, sorry.
Oh, by the way, anything you present, any graph that you produce, you should double check it. Okay, you should assume in everything you do that it could be wrong, including in Fred. Okay, so just make sure and double check once you you know, think that you understand it. Look for a different source of the data to see whether or not there could be a mistake in the concept or a mistake in the way that you've been reporting it and so on. So
yeah, I know, but it's not recorded. It was present. Okay, I wanted to do it faster. Sorry.
okay, yes, but it looks like you got it now, right?
It's not recorded. It's only PC.
But that's fine. We can that's fine. Okay. Now, if you understood the entire historical narrative of inflation in the United States, if I were to express it broadly, okay, what happened is that we started messing up in the mid-60s. Okay, our policies were too accommodative. Arthur Burns was in charge. There's speculation that he was influenced by the Fed and unprepared to raise interest rates enough. And as a result, long-term inflation expectations gradually ratcheted up. And then when the oil price shocks came in 73, 74, they ratcheted up significantly. Central banks then raised interest rates. Inflation expectations came down. When we got the second oil price shocks at the end of the 1970s, now long-term inflation expectations really ratcheted up. So it's very much consistent with this story that we have about endogenous monetary policy credibility. We hire Paul Volcker, and Volcker gives us a massive disinflation. It required driving unemployment rates to double-digit levels. There was an attack on the Fed. That's when we started to get security inside our central banks and death threats and so on. So that was a very costly experience, allowing inflation out of the bag, because it required, 10, 20% interest rates, 10% unemployment, massive bankruptcies, incredible welfare costs. And we still only got inflation down to 4%. By the time we got down to 4%, we didn't really have too much stomach for going low. So what we did is we waited in the 1990s. Sometimes it's described as a period of opportunistic disinflation, because we didn't want to impose a big recession to get inflation down to the numbers that we were hoping to get, 2% effectively, okay? And so obviously, having done that, it took a while for financial markets, having been burned by inflation in the 1970s, to believe that basically the Fed was going to be successful at anchoring long-term inflation expectations. You'd see the term premium before the Great Moderation, in other words, before 1995, was around 2%. Very simple numbers to remember. You know, you have 4 or 5%. You don't have the thing anchored to 2%, to a 2% target. What's the term premium? 2%. You then go through the Great Moderation, where long-term inflation expectations fall to the target. What does the term premium become between 95 and 2007? That's the Great Moderation, 1%. Very easy numbers to remember. 2% before the Great Moderation, when you had 4 or 5% inflation. 1% once people believed that the system is completely anchored. Okay, so now the big question is, what is the term premium now? And the answer is 0. So there is no compensation for future hikes in market interest rates, and that is scary, because if we were to get some news about stagflationary shocks. So let me give you some examples of what that would mean. One would mean the actual data. So the data, the last 2 months of CPI releases have been quite favorable, pointing in the direction of case B. What would happen, for example, when we get to August and we get to see the July CPI, and let's suppose it surprises on the upside. And let's suppose it surprises on the upside in September and October. So that would be one way where the market would get concerned about inflation, because it's actual inflation and they're observing it higher. Another possible way you could get a higher term premium would be if that happens, and at the same time there's a debate about central bank independence, where the market then gets very concerned that the Fed might not do what it needs to do to raise interest rates, because in some way they're constrained either by politicians, it's the Trump administration, or they're constrained because they realize they can't raise interest rates because of debt dynamics and so on. And so that would be very concerning for the market. Potentially, that would be more like a case X scenario, where basically not only would it actual inflation surprise on the upside, but you'd have now an attack on central bank independence. Central bank independence empirically is the dominant thing in the game. You cannot anchor inflation expectations if you have conflict between monetary policy and the politicians, or effectively what we say in technical language is no fiscal dominance. Okay, everything lumps under that. Okay, so you're going to have to learn Fred to basically do this. Who knows Fred now? Can you put up your hand, please? Okay, so fantastic. Okay, good. That's wonderful. Okay, because what we'll do is we'll pair you up with people that don't know Fred, and then people that know Fred can teach people that don't know Fred. We're just going to send you a list now of basically all the variables that you'll have to monitor. Okay, now if you're doing this professionally, for those people that are trying to be on the production team, you should know all those numbers. Professionals that are the best at this would carry around about 100 numbers in their head all the time, and those 100 numbers would actually be updated every month. Okay, but in addition to that, of those numbers, you would be deciding on the ones that you want to store indelibly. In other words, the one that you want to store because they're critical for you to tell the story about what actually is happening historically, credibly, that you actually know specifically what happened historically, and so on. So that means that you're going to have to increase your memorization skills, and I don't know, you know, that might take some work, just like it's going to take some work, you know, cutting these audio files, improving your speaking and your organizational skills and everything else that you get out of that. So Anahit will send you the list of variables. You can work independently, okay? Put up your hand if you know Fred again, and the other people that don't know Fred can look at the people that do know Fred, and what I would do is try to partner up with those people, and maybe they could help you out a little bit. So this is your assignment. You're trying to do a presentation, as we described, 10 minutes on describing what F has for 2 minutes, okay? That's what you're working on. You're trying to come up with a video much like Anna did, but you have a maximum of 30 minutes, 10 minutes, explaining to someone in a non-FF central bank, like the Bank of England, where they're talking about all these kinds of issues, but nobody has any idea what to do, or at least nobody is showing us the plan about what they plan to do to catch up to a lot of the things that we implemented in 30 years ago in places like the Bank of Canada, in places like the Reserve Bank and Seal. Okay, number 2, you have to give a 20-minute presentation to motivate your case A and case B scenarios, and then to present the case A and case B scenarios, but they won't be necessarily your scenarios. There'll be scenarios that ICAPS generated in 1 hour yesterday, because the results that were coming out of the model, you know, were complete nonsense. Okay, and so you'll have to realize that when you're doing this kind of analysis, you cannot fall into the trap of the model sets. Most scenarios start off, and most economists start off with this thing, not a model. In other words, they write down what it is they're thinking about things, and then they use models to help structure their arguments and their presentations about things. So we're going to be talking about that at 4 o'clock. It is going to take several days to get you into how you use models to do this, and how you do not use models to do this. Unfortunately, a lot of the people that were looking at the lines drawn from the model, their first instinct was, I need to have overwhelming evidence that I need to change the assumptions in the model. We're going to change that to be, let's assume the model is completely nuts. The economist is responsible for actually deciding at the end of the day what a sensible line is in all situations. And for you to have confidence doing that, you need a person like Sheldon and I to tell you all the mistakes that people have made historically with that attitude that they have to develop a model to tell them what the answer is. And it's just one mistake after another mistake in central banks and so on. So that's where we are. By 4 o'clock, you still, follow the same work ethic. You create a 15-minute audio file about what are you up to, what are you doing, what your plans are. You ship that audio file on the hour, and then by the end of the day, which is as late as 9 p.m., you send them to the WhatsApp app, those video presentations, and Alex will go through them, Emma will go through them. They will be the pre-filter. So the ones that are getting close to be polished, they'll send on to me. I will look at them at 6 o'clock in the morning and go through the ones. If they are close we will tell you that you're close. And then, of course, we'll try to polish it, put it on the YouTube channel. It will be a submission to the governor's challenge, basically how you use that FastMark 2 to create scenarios. Okay, any questions? Yeah.
Should it do sometimes between Mark 1
Bana sakinlik.
Sometimes, I'll tell you this, sometimes when you're explaining something, it's better to explain something else in reference to it. Okay, so I think that's probably a good strategy. Okay, but you know, but the point is that there's no right way to do this. You internalize it. It's from the perspective of Legacy. So we don't want 20 presentations that are exactly the same. Even though you might have 20 slides that are exactly the same, we want completely different stories. We want stories that you internalize. That's the big thing. We don't want you presenting stuff on a slide. We want you telling the story using the slide as props for telling your story. Okay, so that is really critical because you know we know that the big problem here when you have this hierarchy kind of system, you're looking for a model to tell you the answer, you're looking for slides to tell you the answer, and so there's a tendency for people to be constrictive and to put too much stuff in the slides, way too many graphs, way too many words. Okay, so the slide should simply be, you know, there's some very simple graphs that you can tell your story around. Okay, so that's probably I think pretty good advice. Okay, so we'll see you at 4 o'clock. Yeah.